Greetings, comrades. The 6 QCs that underpin the VCE accounting course guide the way that we report information. So keep this in mind when prepping the cash flow statement, the income statement, and in particular, the balance sheet. So we have these 6 QCs here that I'll go through that basically guide the way that accountants prepare their reports. Now, with these 6 definitions, I've pulled this definition straight from the study design and underlined the points of emphasis when you're unpacking it in an assessment scenario. So with timeliness, the point of emphasis is the information from the cash flow statement, the income statement, the balance sheet needs to be available to the decision makers in time that will basically enable them to make informed decisions. So who are the decision makers? Well, the decision makers are the owners, management, investors, potentially the ATO. And so therefore, they need to have access to things like the profit. Because if we've had a bad year in terms of performance, then having the information about your expenses, your gross profit, your revenue in a timely way means that it will influence the decisions, because maybe the business has had poor expense control. So we can target that for the upcoming year. Same with the balance sheet. We need that information presented in a timely manner to the management, to the owners, etc., because we might have a liquidity crisis. And if there's a liquidity crisis and we're not in a position to pay short-term debts as they fall due based on comparisons between current assets and current liabilities, maybe we need to inject some more capital. Maybe we need to sell off an NCA. Maybe we need to borrow more long-term to deal with the short-term. Now, again, understandability might seem rather intuitive. We need to understand the reports, but when you're explaining this, refer to the study design terminology. The financial information from that cash flow statement, income statement, balance sheet needs to be comprehensible to the users of reports if we assume they don't have an accounting degree or background. So therefore, if we take the cash flow statement, what will help understandability and support this QC is if we classify our cash flows into operating, investing, and financing. And so therefore, a user can basically examine the cash flow for a reporting period, which might be a year, and they can look at the operating section and go, it's been a good year or it's been a bad year, because maybe the cash has been propped up by financing activities, loans and capitals, which is not sustainable long term. Same with the income statement. Let's say we've got a low profit. That doesn't help the user of reports, the readers, management, investors, etc., understand why. So if we look at the gross profit at the top of the income statement, that might be healthy, but all of that might have been eroded from poor expense control. So therefore, being able to interpret that, that's when we can kind of make informed decisions about how to move forward. Now, relevance seemingly comes up in every exam. And so therefore, again, referring to the key terminology in the study design, which I've underlined here, that the relevant information in the reports needs to help the user make decisions based on past, present, or future events in terms of their decision making. So therefore, we need to include information in our income statement, in our balance sheet in particular, about depreciation adjustments, allowance for doubtful debts. We want sales returns reported in our income statement so we can look at customer satisfaction as kind of a KPI, etc. And what we want in terms of including relevant information is we want to make sure that we're not over or understating items in our balance sheet or income statement. So particularly things like the value of our inventory based on inventory loss, inventory write-down, accounts receivable in terms of adjustments for allowances for doubtful debts. Now, faithful representation has some major overlap with relevance. So if you're presented with an exam scenario and you're 50-50 on whether it's relevance or faithful rep that applies, potentially both do. And so therefore what you need to do is pick one and then refer to the terminology in the study design, which again I've underlined and put in brown, so that you are basically showing the examiner, your teacher, that you are clear on how to apply this QC to the scenario. So the points of emphasis here are that the financial information represents a real-world economic event, and it's complete and it's free from error and bias. And so therefore we need to avoid the use of estimations and opinions when we're prepping reports. And therefore this creates a bit of a conflict when we're adjusting for depreciation, because we need to use opinions and estimations for determining our useful life of a non-current asset and our residual value. And same with making allowances for doubtful debts based on percentages of net sales historically. So the important thing here is that reports are complete and they reflect recent economic events. So therefore, for instance, if we're looking at a contribution of a second-hand asset from the owner, non-current, this is where fair value comes into play, because we want our balance sheet to provide a complete picture of recent economic events in terms of the value of our assets, liabilities, and our owner's equity. Now, the points of emphasis with the comparability QC is that we want to present our reports, cash flow, income statement, balance sheet, in a manner that enables our users to compare performance, financial position, cash flows from year to year, so that they can evaluate trends and make informed decisions. The best example of this is depreciation. So when we acquire a non-current asset, we've got to make a call on whether it's going to have an even revenue earning pattern over its useful life. And if that's the case, we go straight line. Or if it's going to vary and contribute more to revenue in the early years and less in the later years, then we go with the reducing balance method. But we can't switch halfway through the useful life of the asset, because that won't help the user of reports being able to understand similarities and differences from year to year when looking at the impact of depreciation on net profit, and also the value of our assets if we look at the effects of accumulated depreciation. Verifiability is all about evidence, and the evidence of all of our financial information is our source documents. So therefore, our users of reports, management, investors, the ATO, etc., can reach a consensus on how the financial information is reported, it's faithfully represented, because we can go back to an EFT statement, an invoice, a memo, etc.